Welcome to Classic Value Investors. My name is Mariusz Konieczny. We're talking again about the oil tanker market. I find it again fascinating because just a few weeks ago, when you looked on Twitter, Seeking Alpha, there were so many advisors. I mean, there were so many people that were talking about the shipping market. There was even a guy with a name, the shipping man. I don't see him anymore. I'm not saying he's not invested anymore, but you know, if you went on Twitter and you went under the particular ticker symbols of the oil tanker stocks, I mean, everyone had an opinion. And now it's a very lonely place. I'm like the only one talking about it. I mean, not the only one, but like very few people. It's a very, very lonely place. And when I was doing my research on the market and really learning how it operates, one of the things that I found that was extremely helpful was the book, The Shipping Man. And if you want to know, on Amazon, I have the description for it in the in the description of this video. And I suggest you read it. I am not affiliated with the author at all, but I think it's a fantastic book, and it really shows you the kind of mentality that you need to have to survive in this market and not being taken advantage of. I remember, and only a few weeks ago, my friend would call me occasionally. We were talking about the volatility and his concerns about this or that, and I just said to him, read this book. Then he called me again, concerned. I said, did you read this book? No. Okay, we're not talking anymore. Read this book, because it will really put things in perspective. It will show you how wild and crazy the oil tanker market is. And in this video, I just wanted to highlight a few quotes from this book and maybe talk about them a little bit, just to put things in perspective and kind of help us, if assuming you want to stick it around, okay? And I'm not saying you should, but assuming you want to stick around, some of these quotes and this book will help you with navigating this environment. So, quote number 1: you generally don't get a good price and good cash flow at the same time. To be honest with you, I should have listened to this quote a few weeks ago, because we had a good cash flow, but because we had a good cash flow because the rates were really high, the price wasn't as good as it is today, right? But where I went wrong on this was that I thought that this huge cash flow, like for example, TK generated the entire market cap in 9 months. So I thought that this huge cash flow was actually going to matter to people, and obviously it doesn't. And just to put things in perspective, if you have a company that's trading for a PE ratio of 10, right? You have to wait 10 years for that company to earn its market cap. TK did this in 9 months, and nobody cares, right? He did it in 9 months. That's the past. Now they're looking at what's the next quarter, and they don't care that the company earned market cap in 9 months. If another example, if a company has a PE ratio of 20, it takes 20 years to earn its market cap. Again, TK did it in 9 months, right? That just shows you how crazy this is. And if you are involved in something like Tesla, well, Tesla, I don't know, it would take infinity to earn its market cap, considering where it is right now and considering that, there is really no profits at this point. So, just kind of let that sink in. The next quote: only time will tell if you make a good deal in the shipping business. 100% agree. Calling someone that they are right or wrong because the price moved, 20, 30% one way or the other, we will only find out with time if we made the right choice. The value of a ship is determined by the cash flow that people perceive it will generate over a period of time. Charter rates must remain at very low levels for a very long time before the confidence and psychology of ship owners is affected. And don't forget, not every ship is open at any given time. Many are on charter or even on a voyage. So just because charter rates drop today does not mean ship owner will be resetting his revenue based on that lower rate. It is like a bond portfolio. That's a really good quote. That really shows us, because people are now petrified about how much the NAV will drop, because NAV is the values of ships, right? Taking account the debt and equity. Well, when the rates were really high, the values of ships didn't go up a lot, right? Because the rates, when they were sky high, everybody knew they were not sustainable. And now, when the rates are low because of the release from the floating storage and stuff, also the values of the ships will not go to such low levels, because the value of a ship is determined by the future cash flows discounted to present. And what are the future cash flows? Well, it depends on what people think the future cash flows will be. Only Wall Street people might think, the cash flows are going to be really bad. Well, we know that the supply and demand looks very favorable, and therefore there is a high likelihood that the future rates are going to be reasonable to give the current ships a reasonable valuation. And if the ships are younger, they have more years left of productivity. So those ships will not fluctuate very much with the fluctuating of rates. But if your ship is old and let's say has 2 years left, well, then the value of the ship will fluctuate a lot in comparison to the rates today or the rates in the near future. So if you take a look at a company like Nordic American Tankers, their ships, about 60% of their ships are old, so the value of their ships should be more volatile in relation to today's or in the near future rates. But if you look at a company like Scorpio or Frontline, well, they have the youngest fleets, so the value of their ships shouldn't fluctuate as much with the recent rates. And another thing from the quote is, don't forget, not every ship is open at any time. Many are on charter or even just on a voyage. That's also a perfect part from the quote, because you look at your VLCC app and you see a particular rate. Well, that's just a rate that was fixed like yesterday, right? It's not the rate that all the other ships at work are earning. The portfolio of ships, it's like a portfolio of, let's say, office buildings. Each office building is on a particular lease that has a length of time. The same thing with the ships. They are out there on particular contracts, and in case of, like, let's say DHT, a significant portion of the company's portfolio of ships is on long-term contracts, more than a year, earning very good returns. And TK also, when I was talking to them on the phone the other day, they also told me that I think it was like 24% of the ships are on really good rates. So whatever the app says, that just shows you what a particular deal was struck between a buyer and seller. Next quote. He learned that no matter how smart you are and how much analysis you did, it was basically impossible to predict the shipping market. I mean, thank you very much. You see so many smart people out there trying to predict what's going to happen. Analysts, CEOs, and if you listen to some of my interviews with the CEOs, I mean, literally weeks apart, and you learn that they were wrong about a bunch of things. And they were not wrong because they're stupid or because they always want to be promotional. No, they were wrong because this market is very hard to predict. And the same thing goes to analysts. If you look at the analysts, half of them agree, half of them disagree. And if one particular analyst is right, they're going to be, it's more like luck. They're going to be right, and then next time they're going to be wrong. And again, it's not because they're not smart, it's because there's so many variables. So the best thing you can do is, figure out how much you're paying for a ship and figure out the dynamics, supply and demand dynamics. That's why I'm talking about this so much, about the supply. And I do understand that people are like, well, you're only looking at the supply side. What about the demand side? The demand is going to suck. I see the demand recovering, and interesting today because I was, for those of you who don't know, I teach ballroom dancing as one of the ways to make money. And one of my students had a lesson today, and she just came back from LA. And so she went from Chicago to LA. And specifically, one of the first questions to her, I was like, so you must have been like the only one on the plane. And she was like, no, the plane was absolutely packed. And the airport is a crazy place. It's so many people there. I was like, wow. So people are returning to flying. And that's exactly what I thought was going to happen, but it might not happen as fast. But, we are recovering. And if you want to be in denial, or you're looking at some outdated data, or maybe the data today doesn't prove what you want the data to tell you, that's fine. But I have a more optimistic view on the economy and how this recovery is going to happen. And you don't have to agree with me, but that's just my point. Next quote. That's the funny thing about ships. They are actually more attractive to buy at 20 times EBITDA and even negative cash flow than they are at 4 times EBITDA. Another good quote. You see, when the rates are high and they're generating huge amounts of money, and then you look at that earnings and you look at the price for market cap, it looked really, really good, right? That's why a lot of us got involved and purchased the shares. A lot of people looked, they are trading at 2 times cash flow or 1 times cash flow, they're cheap. Well, so what this quote is saying, that when the earnings drop, the price that you pay, even if you pay half as much than what you did when the cash flow was high, even when you pay half as much based on the earnings, you might be paying a higher multiple, but that multiple might actually be a better multiple than the low multiple, because those earnings might be depressed because you're looking at a particular very depressed rates. But that's why it's and even when they're talking about even negative cash flows, that when they're losing money, you're like, oh my God, I can't touch this. It looks so expensive. They're losing money. Well, again, this might be a better entrance because everyone else is looking at this and nobody else wants to buy these things when they have negative cash flow or very high multiple, but they are willing and very happy to buy it when the cash flow goes sky high and then the valuation looks cheap. Next quote. When it comes to shipping, investors only lose money when they lose patience. Yeah, I totally agree with it. Next quote. Yeah, well, not everyone thinks like a shipping man. Some people think that when things get bad, they are likely to get worse. So they cut their losses and move on. I don't think I have to say anything anymore. So I strongly encourage you to read this book. It's fantastic. It really puts things in perspective. And another fantastic story that I want to say, that I don't have a quote, but it was just kind of like within the book. It's just fantastic. So you had this guy that was running a big shipping company, and he hired Robert, who was the main character in the book, to go and get him financing. And because at that time his company was had negative cash flow, Wall Street wanted to take advantage of him, and he told them that he could only pay 10% per annum. And they wanted to take advantage of him because the financials didn't look good, and they wanted to charge him 20%. And I don't know the exact numbers, but I think he raised like 300 million from Wall Street investment banks. And because Wall Street and investors in general are so focused on yield and today, and everything has to be so consistent and perfect, what they said, okay, we'll give you this 300 million. And again, I don't know if that's the exact amount, so if you read it, you can correct me. But for now, let's just stick with this 300 million. But they said, but you cannot use the entire 300 million. You can only use, I think it was like 200 million. And then you have to keep that 100 million. So you would keep paying us dividends or interest, even when the underlying asset wasn't generating the money. So in other words, they wanted to make sure that the monthly cash flow would be coming in. But that 100 million, Wall Street wanted him to keep it in the treasury bills. And the shipping guy was like, I will only agree to this deal if I can if you can change that requirement. In other words, if I can invest, if this money can be invested not just in the treasury bills, but also in corporate securities. They were like, okay, yeah, sure, you can park it in corporate securities and treasuries, whatever. So then the deal closed, and he got the money, and something blew up, as it always does in the shipping market, and actually his accounts were frozen. I think it was by the government. They were frozen. So he couldn't even make the first payment, right? So imagine those bonds, right? Because these were bonds. I mean, they defaulted like immediately, right? So everyone on Wall Street was upset. They didn't understand the shipping market. So like those bonds went from 100% face value to like immediately overnight, like 50% haircut, right? And everyone was upset and yelling and all sorts of things. And you know what that guy did? He took that 100 million after they unfroze his account, and he bought back those bonds at 50%. I mean, do you follow the story? So Wall Street gives him 300 million, okay? Face value, 300 million. And then something bad happens. That 300 million goes to like 150 million, okay? And this shipping guy takes the 100 million that they give him, and he buys back almost the entire bond amount, okay? And this was just a fantastic story. And of course, after the market turns, the rates go up, and the shipping guys make huge amounts of money. His company goes from being worth negative to like $1 billion, and the stupid idiots on Wall Street lose most of their money because they didn't take the time to understand the shipping market. They weren't patient, and they were greedy. So strongly encourage you to take a look at this book. For today, that's all I have to say.